Good morning from London. I'm Kriti Gupta alongside Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Traders boosted bets on a September rate cut by the Federal Reserve, with Treasury Secretary Scott Bessent saying it's not enough.
We should probably be 150, 175 basis points lower. So, I think the committee needs to step back.
And AI powers U.S. stocks to another record close, but chip delays and China trade tensions continue to linger. Plus, Donald Trump warning of severe consequences on Russia without a ceasefire agreement, promising to push for a second meeting that includes the leader of Ukraine. Val.
Let's check in on these markets an hour ahead of the opening trade here in Europe, and it is looking a bit risk-off when it comes to European equity markets. Euro Stoxx 50 futures down 0.25%. S&P Futures also in the red. It was quite a negative session in Asia. The Nikkei down 1.5%. Some tech stocks in China not doing well. We'll get to that story in just a moment. Euro dollar not doing very much at 117 handle, and the U.S. 10-year yield trading quite steady at 4.23. The countdown to the opening trade starts right now.
Thursday the 14th, good morning. I have good news and I have bad news about the UK economy. Let's talk about the data that is dropping onto the screen right now. It's better than anticipated, as a result of which you have the pound popping a little bit. We're not exactly at session highs, but we're off our lows. I think we'll take that as a piece of good news for now. So the GDP year-on-year number comes through at 1.2. That's down from 1.3, but is above the estimate of 1%. The expectation is the UK economy is going to slow in the back half of this year. The quarter-on-quarter number comes through at 0.3, which is a big slowdown from the 0.7 that we saw prior, but is still better than anticipated at 0.1. How does this change the calculation around the British economy? Probably not very much, to be brutally honest. And you take a look through some of the industrial production data that we're getting as well, and some of the government spending data as well. None of this is particularly positive, nor is going to move the dial. But at least there is slightly more better good news coming through, if that's the right way of putting it, in this market. It's going to be interesting to see, ultimately, whether or not we'd see more tax rises coming in the autumn, and whether or not that has another effect in terms of slowing this economy down. So let's park that for one moment. Let's talk about what is happening with the bigger picture, Kriti. And that is, as you referenced in the headline, some of the comments we're getting around the Fed, how much the Fed should be cutting, where Scott Bessent is getting these numbers from, the whole calculation around whether or not we should be 25 basis points lower, 50 basis points lower, or maybe even 150 basis points lower for the Fed.
Or I'll throw another number, 175, as Scott Bessent said, the upper target of that. Look, there's plenty of data coming in today as well, so we'll see if this kind of betting in the market actually changes in the next 24 hours, given the PPI data as well. But for now, it looks like traders are saying a September rate cut is a done deal at the end of the day. 4.23 on the 10-year yield.
Yeah, you can also add the fact that we had President Trump weighing in again on monetary policy. He's not shy these days, calling for 3 to 4 points of cuts when it comes to the Fed fund rate. I mean, that would be a return to nearly zero interest rates. But yes, we are in a new paradigm, a new world where we have comments on monetary policy coming from all over the Trump administration.
The Fed still sets rates, right? I just want to check that it is ultimately still the Federal Reserve that makes this policy, because the market's reacting a lot to what the government is saying, not necessarily the Federal Reserve is saying at the moment, which I find fascinating as well. I also find it fascinating that Bessent is tearing up the rule book, and I'm not sure it's just tactless or tactical that he's talking about the yen as well and what the BOJ should be doing. It's not just his own central bank that he feels that he can influence, it's others as well. Like, I wonder whether the Bank of England is next, or maybe the ECB. The ECB's already done the job, maybe. Trump loves the ECB.
Trump, for now, but or sort of, not really. You know who he dislikes more is the S&P, because of their kind of currency story and their pressure on the central bank as well. But I think to your point is simply that, and we talked about this morning. I walked in this morning. I said, Valerie, I'm so confused by these markets, and you said, look, it's not about the now; it's about 3 quarters time.
Yeah, right. The whole of the Trump administration, Scott Bessent included, thinks that the net effect of Trump's policies is deflationary, and ahead they believe that the Fed funds rates should be lower. But it was very interesting that he did mention, pressure on the Fed. He also pressured the Bank of Japan in one interview, and we're seeing the reaction in the yen this morning, with the yen 0.6% stronger versus the dollar. This goes back to the Mar-a-Lago Accord, speculation of a few months ago, where the argument was that the Trump administration administration wants a weaker dollar to help this manufacturing renaissance and help this onshoring. We saw that again yesterday, maybe hints that is still basically the plan, a weaker dollar and better manufacturing.
And that's likely to perhaps, at least in theory, help boost perhaps the bets into the stock market as well, which for now has been very largely tech-driven.
So the AI trade has been a big key of this equity market rally, a 17th record for the S&P 500 yesterday. Now, there is, I guess, some worries that maybe there is some issues on the horizon. We had an FT report that the DeepSeek launch of their new AI model is suffering from delays. They talked about the lack of sophistication in this homegrown Huawei chip possibly pulling them back. But also, you can add to maybe they are having a lack of NVIDIA's H20 chips. Remember, they've been on an export ban since April.
Everybody's struggling to get their latest models out. And we've just seen that with, obviously, OpenAI. The latest ChatGPT model came out quite significantly later than everybody had anticipated. I don't know. There are question marks around this story as to whether or not you'd actually use the chips referenced in the FT story to train models. So there's a lot of question marks around what is happening here. I think what is interesting, and I think the Journal had a nice piece about this a couple of days ago, talking about the idea that actually China's going down the open source model with its OpenAI, with its AI models. The United States is not. Kind of which one of those two routes to market is ultimately going to prove to be the correct one? If you can commoditize AI models, if you can commoditize the AI story, where does that leave some of the lofty valuations that we're seeing stateside at the moment, with names like Meta, etc.
And it really throws geopolitics right into the narrative of right here. If you're sitting here in Europe and you need to use an OpenAI model and you have an American product and a Chinese product, do you then ultimately have to politicize kind of where you get that kind of dependency, assuming there is no European champion there as well? So that's one piece. But speaking of a European champion,
let's talk about what's happening with Ukraine, the European champion. I'm not sure which European champion we're referencing here, but so Friday, we're nearly there. We're nearly at the Alaska meeting. We're looking forward to seeing what comes out of that. The European meeting yesterday, we saw, seemed to suggest that maybe Trump is very much of the idea that territorial integrity is something that should be maintained in Ukraine. He says there's going to be significant consequences if Vladimir Putin stands in the way of a peace deal. My reading, though, suggested that actually the strategy that Putin is likely to institute here is going to be one of, here is a deal that the US can accept, but not Ukraine. And therefore what happens is the White House points the finger at Ukraine and goes, you're the one that's standing in the way of a peace deal. Not Vladimir Putin standing in the way of a peace deal, it's Ukraine standing in the way of a peace deal. And there is also some history to suggest that whoever's last in the room with Donald Trump maybe gets the nod as well. So, I don't know, the last person in the room could ultimately be Vladimir Putin. Well, so, I don't know, we'll wait and see. I'm not sure yesterday, and the threats that were made yesterday, will hold towards the end of the week.
Yeah, and I also just want to add to that, we do have news that Zelensky is going to be in London today meeting with Prime Minister Keir Starmer. So he does seem to be pushing to get his voice heard amongst European leaders before this key summit tomorrow.
OK, let's talk about what we've got coming up on the show. We've got some great guests lined up. We're still in the middle of earnings season. Later in the show, we're going to be speaking to the chief executives of Hapag-Lloyd in the shipping space. We're going to be speaking to the CEO of Vestas after its numbers yesterday. Bilfinger and Swiss Re are all going to be joining us. Joining us now is Amanda Blanc. She is the CEO of Aviva. Its numbers have just come out onto the screen. First half IFRS profit after tax 819, well ahead of the estimate of 634. The combined ratio, big number for the insurance sector, 94.6 versus 95.4 year on year. Operating profit 1.07, again ahead of expectations. Nice numbers. Good morning.
They are. Good morning.
You're confident about meeting your targets?
Yes, very confident.
So where does that confidence come from? These numbers seem to suggest the momentum is good.
Yeah, I mean, momentum's excellent. Outstanding results, 22% up on operating profit. We've seen the dividend increase by 10% to 13.1p. Obviously, we've just completed the acquisition of Direct Line. But there's really strong trading performance in the business. Operating profit in the general insurance business is up 30%. And we've seen flows onto our wealth platform. Our wealth platform is the biggest platform in the UK, 209 billion. Flows up 16%. So, you know, really strong trading performances. We're very pleased about it.
Confident of meeting group targets. Are those targets going to change? Now you've got the keys to Direct Line. Are we going to get an update anytime soon in terms of what new numbers are going to look like?
Yeah, of course. So, I mean, actually, we only set the targets last year. But with the Direct Line acquisition, we do need to come back to the targets. In November, we're going to do a sort of mini deep dive on Direct Line, what we've found, what we're going to do, how we're going to achieve all the benefits that we've committed to. And we'll talk about that then.
OK.
Let's talk about another leg of your business, if you can, in terms of the growth story. You already have plenty of kind of wealth offerings over at Aviva as well. There's been a big push on both sides of the Atlantic to really tackle the retail base as to get that kind of next leg of growth. How is Aviva thinking about targeting that audience?
So the way that we think about that, we've got a very big workplace business, so the defined contribution pension business. We are the biggest player in the UK. We've got 4.9 million members of those workplace schemes. One of the biggest opportunities is looking at that area where we know that in the UK there are 12.5 million people who will not have enough money to save for retirement. So it's really how do we use Aviva's wider offerings to those workplace pension customers to offer them other savings products so that they can be better prepared for their retirement. So there's huge opportunity for us there, and I think that's what you're seeing with the results coming through today, that we're just really at the foothills of that. So much more potential to go.
Well, Amanda, it's interesting that you mentioned the pension fund story. We had the LSEG CEO, David Schwimmer, around the table a couple of days ago, and he was talking about the idea of tax incentives for pension funds ultimately being conditional on greater investments in the UK. How are you viewing that? Or would you agree that's the way to go?
So look, from our perspective, we are big investors in the UK. We invest £40 billion in the UK, 30 billion of which is in, real assets, in infrastructure. So it's important for us, for the UK, to do well. We believe that through things like Solvency UK, we get good capital treatment on that. It probably, we could continue to do better there. But we are committed to investing over 25 billion over the next 10 years in the UK. I think as pension funds, we've obviously thinking about the long term. So for us, it's, it's a great investment opportunity.
And Amanda, can we have a few words on what you think about the rising competition when it comes to the pension risk transfer business? We know that the likes of Apollo and Brookfield have recently done deals to get into that kind of space. What do you make of these new entries? And do you think that in some way this tougher competition could impact your business?
So it won't impact our business. And the reason why is that we have spent the last 3 years we're a very diversified business. So we can take you from your very first junior ISA to your equity release mortgage and everything else in between. Bulk purchase annuities is just one part of our business, and we've moved our earnings from 47% capital light, 3 years ago, to 66% as we sit here today. That's going to get to over 70%. So we're unlike some of the other players in the UK. We're not reliant on the bulk purchase market. It's just one of the strings to our bow. So, yes, of course, that is going to bring competition. There's no doubt about that. But we feel very confident that a diversified business gives us plenty of other opportunities to go after.
So the positives in the diversified business lines that you have. I've also read that it's your 5th anniversary at Aviva. Would you consider your job done? What's left to tackle?
Oh, no, my job's not done at all. 5 years. There has been a profound transformation in Aviva in the last 5 years. It really is a business now that has got huge momentum. And with the Direct Line acquisition just completed, the job's just beginning, really. We've got so much opportunity to go after.
Just a couple of, you said a few interesting things. Capital light, do you think that demands a higher multiple? Do you think the stock should trade on a higher multiple as a result of a more capital light model?
Well, that is definitely the theory, because obviously you're using less capital, and so you're able to return more capital to shareholders.
Do you think that's being recognised by the market yet?
Well, I think if you look at our share price performance, I like to remember that when I walked in through the door, the share price was £2.73. As I looked at it, I don't know what it'll be this morning, but yesterday it was £6.58. I think when we closed. So I think there's been the share price has performed really, really well, but we still believe that there is plenty of opportunity to go after.
Okay. Right. You also, Kriti asked you about retail, so can I just come back on that? Would you consider acquisitions? Would you consider a way of bulking out that wealth side of the business to include a kind of a bigger retail offering?
So we already have a direct wealth offering.
Sure.
Which we relaunched last year, and we've got 90,000 additional customers in the first half of this year. So we're making really strong progress on that. I think in terms of M&A, we've literally just done the Direct Line deal.
Yep.
That's the focus of our attention.
Have got a taste for it. You don't feel like another one.
I think we need to digest this one first.
Okay.
All right, Amanda Blanc, CEO of Aviva, joining us around the table this morning for your earnings picture. We thank you so much for your time. Let's talk about another earnings story that is crossing the Bloomberg terminal this morning. Hapag-Lloyd is coming out with their numbers. It looks like they're talking about narrowing their guidance despite some heightened uncertainty from global tensions. Now, this is a really interesting one because they're talking about the volatility in freight rates really feeding into some of that uncertainty. I think we should go to the CEO himself and hear from him. Rolf Habben-Jansen, the CEO of Hapag-Lloyd, joins the program this morning. Rolf, a pleasure to have you. Thank you so much for joining us. Walk us through that uncertainty here and walk us through the thinking behind narrowing that guidance?
Well, I think, of course, we're 6 months into the year, so of course there's less uncertainty than there was before. It's been a rocky year, as everybody knows, because of everything that's been happening, amongst others, on the tariff front. Having said that, I think we've had a very solid first half of the year with especially pretty decent growth. And if we look ahead now, then despite some headwinds on the FX front, I think we felt comfortable to narrow down the range a bit.
Well, Rolf, one of the key pieces that you talk about in your earnings picture is simply this idea that the freight rates may actually come down. How much of that is related to trade uncertainty or perhaps certainty on the table?
Good question. Of course, freight rates is the one thing that's the most difficult to predict in this industry. I think when you look at a normal seasonal pattern, then one would expect reasonably strong volume still in the third quarter. But after that, it typically tends to taper off, which also means that short-term rates then tend to slide. If you look at the pattern that we've seen this year, we started reasonably well, then spot rates were eroding, then we saw a peak in May, and since then they have been sliding initially, and I would say that over the last 4 weeks they've been pretty flat.
Rolf, I want to turn to demand out of China. We recently got an extension of the U.S.-China trade discussions for another 90 days. Are you seeing any rush of new cargo orders in and out of China on the back of this extension?
A rush is probably a little bit exaggerated, but I would say that you know, whilst when we were talking to many of our customers over the last 4 weeks, everybody said that there would be no uptick in volume. But when I look at what's been happening, let's say also especially over the last couple of days, we certainly see a bit of an uptick compared to what we saw in the last weeks. But I think to talk about a rush is definitely exaggerated.
Well, Rolf, put that into perspective, that this uptick that you are seeing, are you expecting still some tariff front-running to continue until some sort of deal between the U.S. and China is finally reached? We were speaking to the Maersk CEO last week, and his main case was that we need certainty on the U.S.-China relationship for shipping to really boom back.
And I tend to agree with him. I mean, you know, everybody, and when you talk, whether you talk to shippers or whether you talk to importers, everybody would like to know where they are. That's, of course, where now the extended 90-day pause, if you want, or standstill, is in a way good news, because that'll help people to at least get through the peak season. That's also why I would expect to still see a mini rush, if you want, towards the Golden Week, and as such a fairly normal seasonal pattern. But I think you're absolutely right. I mean, everybody needs to get some long-term certainty, because when the markets become predictable, people will simply take more decisions, as there's too many people right now in a wait-and-see mode, which over time does not have a good effect on demand. And that's where a little bit more certainty and a little bit more predictability, I think, would help everyone.
Rolf, good morning. It's Guy. Any sign of a recession? Can you see a recession happening in the United States? Can you see a recession happening in Europe? What's going on?
For now, I don't think we see that, to be honest. I think, you know, I think predictions and outlooks have been all over the place over the last 6 months. A lot of people have been very pessimistic, but in fairness, so far they have not been right. When I look at container volumes in the beginning of the year, everybody said this year is going to be flat and maybe even with negative growth. If we look at where we are today, first half was 4.5% positive, and I would think that when you look at the full year, that we're definitely going to see a plus, and whether in the end that's going to then be 2%, 3%, or 4%, I think you can argue about that. But it's certainly been better than many people anticipated in the beginning of the year and late last year.
Operationally, how's it going? What's going on in the Red Sea? What's your expectation there? I think we're seeing, obviously, an issue coming as well with the United States and Chinese-made vessels docking at U.S. ports. How's that going to impact things? What does the operational picture look like at the moment?
I mean, maybe to start with the last one first, when we look at the USTR 301, we will be able to mitigate that fully, so that will have no impact on our day-to-day operations. When we look at the Red Sea, I mean, we've all been pretty hopeful that at some point in time we'd be going back through Suez. But if we look at where we are today, I think it is unlikely that we will return to Suez before the end of this year.
Rolf, great to catch up. Really appreciate the updates. Such a useful indicator as to what is happening with the global economy, what is happening within shipping. Rolf Habben-Jansen, the CEO of Hapag-Lloyd. Thank you very much indeed. Coming up, let's get back to the macro. Scott Bessent's comments on Bloomberg, driving bets for a Fed rate cut. We're going to get back to the markets next. This is Bloomberg.
I'm going to cast a wide net, 10, 11 people, and then there'll be a group of us who are meeting with them. They're going to be private sector names. So we had a series or a list of current Fed members. We're going to have some private sector, very well respected,
like who?
Very well respected people.
I'll be naming a new chairman sometime within the next, I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names, all good, all great.
Donald Trump there and U.S. Treasury Secretary Scott Bessent seem to be singing from a different hymn sheet when it comes to the race for this new Fed chair. We had the president there talking about how he's narrowed it down to 3 or 4 candidates. He wants to pick a candidate sooner rather than later. And Bessent adding 3 names, an additional 3 names to the list just yesterday. That list from Scott Bessent is reaching around 11 to 12 candidates if you include everyone who has been discussed. Rick Rieder has been the heavyweight that was talked about yesterday. He is the fixed income head over at BlackRock, but all 3 of these candidates focus more on the private sector. So it does seem to be that the Treasury Secretary is casting a wide net, not just considering those traditional to monetary policy. I do want to note, though, we also heard from Scott Bessent about this pressure on front-end rates. Also, Trump yesterday talking about the need for rates to be 3 to 4 points lower. That is continuing this rally in the front end. We're now fully pricing that September Fed rate cut, and you can argue we're starting to creep into 50 basis points territory with what we're pricing right now. And that is leading to this risk-on rally. S&P 500 notched another record yesterday, but there are some early signs that maybe we're about to pull back from that record. We are in the red right now when it comes to futures. And take a look at the slide in Bitcoin. Yes, it did notch a new record high in the Asia session of 124,000, but it's fallen quickly back off that guy.
Today's a big day in so many ways as well, in terms of encapsulating the debate that is going on at the moment, not just around what is happening with the Fed, but also what is happening with the macro data. So you're going to get claims data a little bit later on. Claims have been ticking higher. You've also got the situation on the inflation front that may be answered today by the PPI data. PPI obviously folds into the PCE data, which is going to be quite significant. So I think 2 pieces of data today out of the United States that may further inform us about what is happening with this economy.
Yeah, and I think we've gotten a lot more sensitive lately to labor market data with jobless claims. We know that initial claims have held in okay, but there's a continued creep higher.
Just pushing
in continuing claims. That's a lot of the word continuing there, but yes, a trajectory higher in continuing claims, which is now starting to worry the market. Now with this revised payroll report, it's adding some skepticism on where the labor market is just now.
It's a fascinating one. We've got a couple of earnings as well. The Deere story is fascinating, given, of course, the exposure to the U.S. economy's largest export, of course, and Applied Materials after the bell. I'm wondering about this Fed rate cut that's obviously priced into this market. If we get one in September, does the market sell off on this? Is this a buy the rumor, sell the news kind of moment?
Like 25 basis points feels like just a drop in the ocean, doesn't it? Like that's
sure, when we're
not
talking about like 175.
I mean, I think when it comes down to that, it's going to be more about the guidance. Is the Fed going to be open about wanting to cut at every meeting for the remainder of the year, or are they going to stay guarded, waiting for more data?
That would certainly be the tone that we've had thus far. Vestas is going to be joining us next. The CEO is in the building. He'll be joining us in just a moment to talk about what is happening with the wind turbine business. Henrik Andersen up next. This is Bloomberg.
30 minutes away from the start of the opening trade. A little bit of a divergence when you look at the futures picture. Euro stocks at 50 futures down about 0.2%. You take a look at the FTSE 100, though. They're an outperformer, but not by much. Only higher by 0.1%. Some of that may just be a little bit of a reaction to the fact that the stock market yesterday closed at a record high over in the States. Maybe a pullback globally is what we're looking at, waiting for the FTSE 100 perhaps to shake out as we get closer into the open.
Well, the bond rally was a big part of the equities notching all-time highs yesterday. Let's check in on European fixed income. Little changed here when it comes to Germany, France, and Italy 10-year yields. The next kicker for fixed income could really be out of the U.S. We do have U.S. PPI and jobless claims dropping at 1:30 London time.
Let's get back to the earnings story. Vestas maintaining its full-year earnings guidance as the Danish wind turbine maker navigates the impact of U.S. tariffs and what can only be described as a shifting energy policy stateside. The company says demand in the U.S. remains, quote, robust and strong. Let's get some more details on what exactly that means. Joining us now around the table is Henrik Andersen, the CEO of Vestas. Good morning.
Good morning.
Robust and strong. What's going on in the States right now? For Vestas, we can talk about the bigger picture later.
No, I think for sure the demand side is looking to see how we're building the capacity. How can we get fast and quick access to further expand electricity? And I think that's what's going on. And that, of course, from us, from a supply chain, we have been ramping up our factories for quite some time. It's now in full motion. It's 25 will be the busiest year in
America.
In America, yes. And then, of course, it's all now, as you can. The split between Q2 and Q3 has already happened because, of course, change of clearance of policy came in beginning of Q3. And you can see that we have had a number of order intakes. So people have been lining up, waiting for what was policy clearance.
So you now have clarity. The back half of the year looks like it's you've got to perform in the back half of the year. What you're telling me is that that expectation is there, that you are going to perform. The back half is going to be stronger, that the momentum is building.
Yeah, but we've said that ever since we released the full year for 24. It's sort of sit here and
that was my next question.
Christmas is coming closer, and we have done that, and you can also see from a just pure production leaning into it, ramping up, and that means we will have something 60-65% of both.
So it's
top
here.
line.
Christmas is coming.
It's already started.
Okay.
At least from a Vestas point of view. So we are doing a lot of that right now, and it's Q3 will be busy, Q4 will be busy, and that's not unusual. But this year it was, and we said that all along from beginning of the year. It is further back end loaded than what we probably normally would see, and of course that's what we are balancing.
Well, Henrik, let's dive into the nitty-gritty in terms of American policy, if we can. I think the last time we saw you, the big, beautiful bill hadn't been passed just yet. It hadn't gone through the system. Walk us through the tax credit story there. How much of the cutbacks feeds into this delay?
First of all, it's a change of legislation, and of course, in a change of legislation, until you get that, both the legislation and also the guidance, and we both know that there is a guidance coming out probably within the next week that also says how are you going to deal with especially the notion of put in construction. And the in construction part leads then up to how long can you have it before it's in service. So it means you start building something, you are securing some of the assets, and then in reality it goes into service typically 2-3 years later. And what is in the current legislation mean that you will have to secure that in construction before July 26, which is a year from now. And then in reality, you build those same projects out towards the end of the decade.
Would you consider doing that investment, that build out in other parts of the world, away from the States?
Listen, we are, as you also know, in Europe and in the UK, everyone are trying to revise their programs to do more capacity, to be more independent and self-generated in the energy space. So I'm not surprised to see that a lot of countries are doing the same. EU is discussing it, and then there is a difference between what the US has done cleverly for 30 years, which is putting the incentive to more capacity, rather than where we in Europe still, to a large degree, still try to compensate the user and the consumer.
But does that still mean for you, from an investment standpoint, do you then reallocate the funds, or at least the parts of your business that are looking to the States, into the other countries that, as you say, are ramping up that capacity?
No, but we have continued investing in it because in the US we simply have a demand cycle now that has forced us to also upgrade factories and improve finishing line, which I know we spoke about in the previous quarters as well. So that's working and that's in motion. So that's for us really nice to see.
Good.
I have more questions about not just the U.S. policy. Obviously, we had the tax policy. We know that bill. But don't you still see risk on the horizon from Donald Trump's push into deregulation? He seems to want to deregulate fossil fuel industry. He wants to change the way the Environmental Protection Agency operates. Is that a risk to your business?
I think right now, I think the one thing we probably are, as business, are pretty bad to deal with is uncertainty or unpredictability. And I think it's better to have clearance, just as we saw with the policy coming out. And I think we have an obligation as both industry and business leaders to also stand up and give some of the preferred directions into that. I think the world right now is probably a bit more discussing a wider outcome in terms of energy supply, but it doesn't change the fact that we all see the need for energy and more energy, whether it comes from the way we use our technologies at hand or the mobiles, or it comes for the way we transport or whatever. That still goes on, and that's the dangerous thing, I think, right now, that we get so a little bit emotional, detached from realities. So when you see the demand cycles of energy, electricity and others, you've got to be able to supply to that. And if you go to Spain, if you go to Portugal, that was acutely a reminder of what happens if you either don't have control of your grid or you don't have control of your supply, because then you will face a blackout. There are countries we don't compare with necessarily in the development, where you see blackouts during the week and other stuff, but it was the first time in Europe where you had 24 hours where you were not comfortable.
Is there any advice you would maybe give to the Trump administration, who is trying to restructure energy policy in some way on that topic?
No, I think we have done that in also the previous quarters leading up to the part of the energy section of one beautiful bill. So I think we have tried to do ours there, and we'll continue to do ours as a big company in the U.S. We have more than 5,000 employees located in the U.S. as also part of the global setup, and I think some of the other things on components and where it comes from and how you build it is absolutely speaking common sense. And then it's about, sometimes we maybe get slightly emotional around what wind can contribute with and what wind cannot contribute with. I'm the ones that believe in facts, and I'm the ones that can see that it's a 30-year asset. It has a levelized cost of energy with or without the subsidies that will also still be competitive up against the base energy assets. Okay, so there's some stability there. Yeah. What about costs? That's where there seems to be some volatility. Yeah, I think we can. I mean, if you sort of take a look around, I think we say most costs are actually coming into the supply chain either stable or reasonable stable. I think that will be somehow in a little bit of a 2025. Here we are, stable running, because some of the tariffs will have an effect. When you look towards 26, 27. But they're not there yet. Because we're all wondering, when does it all show up? This is sort of this is where a lot of industries, take ours as an example. When you start having tariffs on, then components starts going into your manufacturing. As it comes out, it takes 9-12 months before the tariffs then come out. It takes probably another 6 months before the bill goes to the customer. Did you stockpile in advance? Did you how did you No, we don't do that. We have a supply chain that runs, and we have a global supply chain, but we also have a very huge localization. But it takes a long time for the impact of tariffs to flow through. Yes, it does. It's not like retail. You get a tariff, you walk down there, and it has gone up with 5 cents. That's not the case. So industries, they will run it typically 6-12 months. So there is I would call a little bit the wave of price. How far through that process are we? I think we are halfway. For us, we are halfway, because we saw the tariffs. But then, of course, you also know tariffs haven't been stable. So whether it's 10, 15, or 20, or maybe for Switzerland 39%, then it's that doesn't come in as a fixed point here and now. But when you are close to from factory outside to a consumer, then it comes in much faster.
Well, we're already seeing that read through in some of the data. Does that affect your investment confidence right now? Or are you holding back on making certain investments to get clarity on that?
No, because in that sense, if you look at even a tariff on components, when you look, for instance, in the US for us, it is a minor part of our supply chain that get affected by tariffs.
But if you're talking about a longer-term time frame, are you building up a cash cushion to weather any potential increases in those costs given the volatility of the policy?
No. What we do is contractual with partners. We look at that. And of course, partners, whether I have a partner that is the utility or the energy generating company that then contributes with the energy into the grid, they will then raise and adjust prices according to that. So it's a little bit like what you see in the UK and Europe when auctions seems to be hit by costs going up. Then you either have to adjust your auction prices upwards, and you've seen that in the UK offshore market in a couple of the AR4, 5, 6, and 7 now. That when you adjust and you interact with the world around you, then you know if you need the asset has a price, and that transform into a price of energy.
Well, Henrik, I want to end on shifting to what happened at Ørsted this week with some 30% drop in their share price after announcing a rights issue. What would you say to the market and to investors that your business is different and that Ørsted's problems are not emblematic of the wider sector?
First of all, I feel for Rasmus and Ørsted. It's not nice to be in that situation. It is a company-specific project financing in the US. We don't have that because we in reality are slightly different in the value chain. We are the ones that supply typically the solution, the assets to it. A company like Ørsted or anyone else that buys wind turbines and the solution around it are the ones that own the assets for 30 years. And that's where we are on the other side of the value chain so far. So as I said, and I had the question yesterday on our investor call, can that be fixed from a Vestas point of view? And I unfortunately say it can't, because it's really not where I will be the one contributing to the final total investment pool. But for what Ørsted is doing right now, they are basically financing for that investment pool they have in the US.
All right. Henrik Andersen, CEO of Vestas, joining us around the table on a variety of topics. We thank you so much for your time. Coming up, ThyssenKrupp cutting its full-year forecast and full-year profit and revenue forecast after posting a deeper third-quarter loss. We're going to talk about that and your other stocks to watch at the open. Stick with us. This is Bloomberg. The FT reporting this morning that Chinese AI company DeepSeek has delayed the release of its new model after failing to train it using Huawei's chips. Let's get more with our very own Tom McKenzie, our resident tech expert. Tom, can you just put this into some context for us? How disruptive is this, DeepSeek's operation?
Well, so just a reminder, of course, DeepSeek, really important in terms of the AI theme for China, and it was that catalyst for a huge upside in terms of the tech story in China and the downside that we saw when it came out with its first models towards the end of last year. It came out with the R1 model in January. It was planning to come out with the R2 in May. And what it's been doing is training that model, or at least attempting to train that model, on Huawei's Ascend chips. The Ascend chips have been used for inference. That's the part where essentially you're asking the model questions that we use every day when we're using ChatGPT and other chatbots. That's the inference part. The training part is when they're getting the model ready and match fit. And they were trying to do that on Huawei's Ascend chips. Huawei had a team embedded with DeepSeek, and they still failed to do that. The prior models, the R1 model that DeepSeek put out, the training was on the H100, NVIDIA's H100. DeepSeek is obviously under pressure from the Chinese government to try to use Huawei chips, not just for the inference, but also the training part. And it seems they're struggling to do that, and hence you have this delay in the release of the model and potentially broader ramifications in terms of how we think about the innovation on AI out of China.
So is this just backing the case that NVIDIA still has this technological advantage in the Chinese market, even though they're selling the H20 chip or are going to be selling again the H20 chip, which is, a fair few steps behind its new Blackwell chip?
Yes, two things are true. One is that China still lags when it comes to the most sophisticated chips. In terms of the Huawei Ascend, which is probably the most sophisticated chip in China, you get about 60% of the kind of efficiencies and productivity use that you can do in terms of inference versus NVIDIA's H100, for example, just the lower end of that NVIDIA. So there is that lag. There's also a question about the software. NVIDIA comes with the CUDA software. That's a decade-old process of building a software and the interconnectivity. So in terms of software, in terms of interconnectivity, and in terms of the manufacturing process as well, Huawei has to rely on SMIC or SMIC on a 7-nanometer process. They don't have the extreme ultraviolet machines, lithography machines that ASML provide that can get you to 5 nanometers, 3 or 2. They have to rely on that 7 nanometers. So no manufacturing in terms of producing, in terms of yield, those are all constraints in terms of what China's able to do. But has China made progress, and is it still making progress? Yes. Is there still a gap? Clearly, DeepSeek has reminded that gap remains, and this ties into what the Treasury Secretary has been saying. He wants NVIDIA to be the standard setter, not Chinese chips, hence getting H20 into the Chinese market. Clearly, the Chinese government would like to see a different outcome.
Great stuff, Tom. Thank you very much indeed. Complicated story. Let's talk about what we're going to get in terms of the explanation around this story, because we've got some great shows coming up to do just that. Bloomberg Tech Europe with Tom Ayres this week. He's going to be exploring how AI is changing the way that we all work, how it will change the way that we all work. 6:30 a.m. London time on Friday. London time, 7:30. CET. Let's talk about how all of this is impacting the markets, where we are focusing our attention. We've got PPI data coming a little bit later from the United States, and of course claims data coming up as well. Markets continue to push on. A little bit of a fade maybe overnight. Our Markets Live executive editor, Mark Cudmore, joins us now to talk about what is happening here. I want to talk about these Bessent comments in particular, Mark, to get a comment on that. Bessent's not only commenting on how many rate cuts we should see in the United States, he's also talking about the yen as well. He's talking about the BOJ. How big a departure is this, and how significant should this be?
I think, given the precedent set by this administration in other fields, we're probably much less shocked than if this had come in any prior year. Obviously, Bessent himself has not normally commented on the monetary policy of other nations, so it was a bit of a surprise in that regard. But this is becoming the new norm. I mean, what's funny is that we probably wouldn't have been surprised at all if President Trump had made the same comments, which shows this U.S. administration sees no boundaries of fields they won't weigh into, and that is obviously reshaping the whole market landscape. It's making it exceptionally interesting for people in our position whose job is to full-time kind of study that and talk about that, and it's because it's very dynamic. There's a lot of opportunities out there, but it's also making it extremely difficult to trade. In the short term, we've also seen the yen strengthen. We saw a delayed move higher in JGB yields, but it has to be said that most of the move came this afternoon, long after those comments happened, which was last night, and even long after they kind of got really hyped up this morning. So that was a little bit of a delayed move, but certainly the yen absolutely reacted to these Bessent comments.
Mark, if, for instance, we're getting the early hints that the Treasury and the Fed are going to be working together alongside the Trump administration, is there a trade off the back of that other than being the bearish dollar, as you just mentioned?
I think it's absolutely bearish dollar. I think it's very, very pro-inflationary. So unless you believe that there's going to be some aggressive intervention in the bond market from the Fed in some other way, we're going to get a whole inflationary spike. So you probably want to buy inflationary assets. It's going to see long-end yields spike. Ultimately, that becomes initially positive for stocks, but it becomes problematic over the long term. But other assets that are pro-inflation probably do well. This is why crypto is surging. You probably get other assets like that, real assets that do well in this environment. And everything the Trump administration is doing to undermine institutional credibility and to pressure yields lower is essentially supportive for inflation, negative for the dollar. So that's the underlying backdrop here.
Mark, a little bit of a left field question for you. We are less than 24 hours away from, or at least a little over 24 hours away, between a summit from the U.S. and Russia. Is that a positive or a negative for Europe if we get some sort of agreement or don't?
Yeah, I think expectations are very low, but actually I'm currently lost in this because I'm surprised by the fact that I kind of asked a few people this morning, and anecdotally it seems that the range of expectations is a little bit wider than I had previously thought. My thinking was that the vast majority of expectations that there'd be no big win out of this, but it seems that other people out there are putting a slightly higher probability on that there is some kind of at least superficial win out of this, that, you know, Trump gets some kind of concessions from Putin. Even if it's not a fair deal, it's something that the market reacts to positively in the short term. We'll have to see.
Looking forward to seeing how that all unfolds. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. And more from him and the team, ML Go on the terminal. Let's go from the macro to the micro and get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with meal delivery service company HelloFresh this morning. So it cut its guidance on the back of currency headwinds and weak sales. So we might see a little bit of weakness this morning, extending the losses that we've seen. We are already down 26% year to date. And as Bloomberg Intelligence said, there's a buyback, and that is positive, but that is just not quite enough. Moving on to another guidance cut, this time from ThyssenKrupp, so in the steel sector. ThyssenKrupp cut its guidance. The CEO said there was enormous macroeconomic uncertainty, and there was also weak end markets in engineering, automotive, and construction. ThyssenKrupp has actually been outperforming its peers by quite a large margin, as we can see here. So we might see that gap narrow a little bit this morning. And then finally, let's end on a positive note, and we've got Lundbeck, and this time it's a guidance raise from the pharmaceutical company. Its psychiatric drugs did really well. That's led to a guidance boost. So we might see a bit of a boost after the shares have been down. They're down almost 14% year to date. So there might be a little bit of a lift off the back of that this morning.
All right, thanks for equities reporter Chloe Melly taking us through some stocks to watch at the open, which is just over 5 minutes away. I'm also interested to see how tech stocks fare. We do have the Nasdaq in the red, but just slightly on this FT report that DeepSeek is experiencing more delays on the back of chips.
Absolutely. We've got a defense play out as well in terms of the read through from yesterday's conversation. Zelensky is in London today, or is expected to be in London today, an arrival at about 9:30 a.m. UK time. So we'll see if that's something that changes the defense narrative. It is the opening trade next. Stick with us. This is Bloomberg.
Thursday morning, good morning. A little softness in futures this morning. Not a lot, but a little bit. We've got some key data coming up. We've already seen some good data out of the UK. Gilts are about to open. This was the picture yesterday for European markets, kind of rallying towards the end of the day. Little tick higher into the end of the session. We did finish fairly flat, though. US markets also rallied into the end of the day, just a little bit. We are in quiet August markets at the moment, but vol remains low. Equity markets continue to kind of inch ever forwards. Does that narrative continue throughout the rest of August? We'll see today. At the moment, I don't think we've got a good guide coming from the futures picture into today's session, Val.
Yeah, futures are going nowhere fast. We're a bit mixed across the board, but fairly flat as well. Euro Stoxx 50 futures down just 0.1%. FTSE 100 flat to the upside. The DAX totally unchanged right before the open. We do have some earnings, though, that we are keeping an eye on. Kriti, what kind of stocks are we monitoring?
Well, of course, we have the tech story, the defense story. There's some thematics that we have to keep an eye on that are really going to bubble up to the surface. A couple of individual stocks, though. Hapag-Lloyd is one that we've got our eye on. This is a shipping company that, of course, we just recently spoke to the CEO of just a few minutes ago. They're narrowing their guidance, which is, in theory, a positive, but they have a lot of warnings there. The geopolitical tensions, the Red Sea tensions. Let's see how that's received at the market open. Carlsberg, a similar story. They're narrowing their profit outlook to the upside, but they're saying it's all about a warm summer. So if the weather changes, so does Carlsberg Future, apparently. UBS is another one we haven't talked about this morning as well. This one's interesting. A report from the FT saying that they are falling short of cutting their job targets by a massive margin, it seems. Remember, UBS is going through a massive restructuring after their takeover from Credit Suisse. Is that reporting going to move the stock guide?
Okay, let's find out. Time to actually see some numbers, some ideas as to where we're going. The early trend maybe tells us about the rest of the day. Hasn't been maybe the case of late, but at the moment, as indicated by Val, a fairly quiet August open we are seeing at the moment. Volume's been light over the last few days, all to be expected as we're in the middle of holidays. FTSE 100 is just dipping a little bit. We'll see how Aviva trades. We'll see how some of the insurers trade more broadly today. We'll get an idea of what is happening with the mining story as well. Stock 600 going nowhere in a hurry. FTSE dips a little bit more. Sluggish open elsewhere across Europe. The CAC is not open. There you go, it is open. We're up by 0.2%. The IBEX is up by 0.2%. The DAX may take a few minutes longer. But as I say, I'm not entirely convinced you're getting a good guide as to what happens maybe in September when everybody gets back from the beach off today's numbers. feels like a quiet mid-August day. We're waiting for some data a little bit later on, which may G things up a little bit. I'm quite excited to see the gilt open as well. We'll get an idea of what's happening there. Val, talk to me about the sector story.
Yeah, the sector story, it looks, fairly positive. We're still waiting for more than 100 stocks to open on the Euro Stoxx 600. But we do have media and utilities, travel and leisure at the top of the basket. I'm interested to see that technology is actually one of those sectors that is in the green. So it seems like that DeepSeek story from the FT on delays on issues with their chips, not necessarily having any impact here in Europe. At the bottom of the basket, we do have basic resources. There was a slide in iron ore in the Asia sessions, the likes of Rio Tinto falling some 4% this morning off the back of that. But hey, when it comes to up stocks rising and stocks falling, we have 350 in the green.
Lots of tech stocks moving to the upside, but it is, as Guy said, a summer Thursday, if we will. Plenty of ex-dividends, though, moving to the downside. So when I'm looking at my index contributor here, Rio Tinto, Shell, BP, GSK, a series of names that really aren't necessarily indicative of the broader market fundamentals, but just simply an individual ex-div story. That being said, I really think it's interesting that you do see tech actually trading higher. How many times have we talked about, at least in this show, one, the catch up to what happened in yesterday's session over in the States, but also the idea that whatever this news of DeepSeek actually ultimately means for some of these European players, ASML, SAP, some of your biggest index contributors this morning.
Just a quick look at the gilts market, and I'm looking at the 10-year tenor here. UK gilt yields are a little bit lower. They're not as down as much as we're seeing on the continent at the moment. But again, I just want to kind of flag we are in light summer months. But nevertheless, the data today maybe suggests that actually there is even less need for the Bank of England to cut further from here. We've already seen, obviously, a deeply divided MPC, but the data today better than anticipated for the UK economy. So maybe actually, given the emphasis we are seeing placed on inflation at the moment, maybe the Bank of England backs off further cuts from here. So we are seeing yields coming down, but on the continent they are certainly down by more, Val.
And a few stocks on the move because of earnings. Hapag-Lloyd is up 1.3%. And then on the downside, Carlsberg down over 3%, nearly 4% on the back of their weak earnings. But let's broaden out this conversation and join in our guests around the table. Joining us now is Henry Allen, macro strategist at Deutsche Bank Research. Stocks hit a record high in U.S. yesterday. S&P 500 notched its 17th record this year, up nearly 10% year to date now. Are you feeling bullish about these equity markets?
I am on balance because actually when you get this kind of backdrop where the Fed are cutting rates into a soft landing rather than because of a recession, that historically has been a very good backdrop for risk assets. And one thing I'd also note is that with the negative jobs revisions that we've just had, so months of 14,000, 19,000, pretty weak and close to contractionary territory, I think actually that means there is some bullish upside because investors are getting a bit fearful. Is there going to be a more meaningful slowdown? Are we seeing what we saw kind of last summer, this time last year, where there was a slowdown in jobs growth and people got a bit nervous? So actually, if that does pick up into year end, and I think there are signs it could, consumer discretionary spending is holding up. The weekly jobless claims are looking pretty steady as well. Obviously, administration now putting pressure on the Fed to cut rates more aggressively, then I think you do have some bullish upside there.
How are you thinking about that political pressure? We heard from Scott Bessent. He spoke to Bloomberg TV yesterday, calling for 175 basis points of cuts. Also, President Trump yesterday talking about 3 to 4 points of cuts. I mean, that would be taking us back to nearly zero interest rates. What do you make of this political pressure?
Well, I think one of the strategies they're doing is basically trying to shift the Overton window for kind of what is acceptable. So by Bessent throwing out 50 bips and then Trump himself throwing out 3 or 4 percentage points of rate cuts, suddenly a 25 bip rate cut seems fairly modest and achievable.
Moving the goalposts.
Exactly. So, it's that kind of time-honoured strategy doing that. Bessent himself was saying, 150, 175 bips is where he'd like to get to. So despite the fact the Fed are still operating 4 years later with inflation that is still above target, even now, headline and core PCE are 2.6 and 2.8 and expected to rise later this year given the tariffs, the Fed are still talking about the direction of travel being lower, whether that's September, December, whatever. Markets are pricing that in, and that in and of itself is easing financial conditions and supporting the equity market.
Well, is that the risk, though? The fact that it is supporting the equity market, the fact that these rate cuts are baked in to the stock rally? So ultimately, if September comes around and we get this rate cut, is that a sell the news kind of moment?
I don't think necessarily, because I think it depends the reason the rate cut doesn't happen. If the reason the rate cut doesn't happen is inflation, so we get a hot CPI next month, PC later this month comes in strongly, then I think that's a catalyst for a sell-off potentially. But if the reason is that job growth picks up, that economic growth is strong, then I think you'd have the pattern you saw in early 2024 when the market went into 2024 pricing 6 rate cuts from the Fed that year pretty rapidly. We got through the first half of the year, none happened. They didn't cut until the large 50 bip in September. But actually early 2024 was a great time for risk assets. The S&P had some of its strongest moment that year because growth is surprising on the upside. So I think if growth is surprising on the upside rather than inflation, then it isn't necessarily the catalyst for a sell-off.
And if we do get that cut, if it does manifest, then is that the sell the news moment?
It depends how hawkishly they frame it, I think. So, obviously next meeting we've got the dot plot. If they say that's the moment for a series of rapid cuts, then that's clearly bullish. But I think the other thing the market is really focusing on at the moment is not just Powell and how the current Fed frame it, but they're aware that obviously Powell's term is up in May. By only 10 months' time, potentially before that, if Trump takes more aggressive action and fires Powell, you're going to have a new Fed chair in place. All of the people auditioning for that position are saying they want to cut rates more aggressively. So I think whether or not you get that cut in September or December, I think what the market is now doing, and one of the reasons things are getting so bullish, isn't so much that timing of the first cut, it's the fact that you now have a more dovish profile priced in throughout the Fed funds futures curve. Because indeed, actually, one thing I was struck by yesterday is one of the strategies that one article said the administration were employing is by having this short list of 10 or 11 people, they are basically trying to get a situation where lots of talking heads are going on shows like this one, calling for rate cuts. And that's kind of, again, shifting that over to a window, making it seem acceptable.
Is
even
that
though
actually happening, or is that the going theory? That's the speculation.
Well, I think it's happening in the sense that a lot of those names in the frame clearly know that if they want to become Fed chair, President Trump has made quite clear his criteria, and all those names in the frame who are realistically being talked about, even some of the more traditionally hawkish voices in the past, are finding ways to justify rate cuts. We saw that from Kevin Walsh. He's saying, we can justify rate cuts by shrinking the balance sheet. He's able to employ these methods by which he can get to rate cuts.
Guy, he's making me lose faith in humanity.
Or just the Fed's rate-setting policy. Humanity's maybe a bit of a stretch. What I don't understand in this market is that it's being driven by tech. But tech's not macro-driven. Tech's not driven by what happens with the US economy. Tech's driven by this huge AI spend. So you've got a market that's being driven by this kind of really small subset, obviously of heavyweight stocks, that are disassociated from the macro data that we're all spending our time talking about. So what is driving the market? That's the bit that I can't figure out. Is it the AI story? Is it the rate cutting story? Because if it's the rate cutting story, why is it the AI story? If it's the AI story, why am I bothered about what happens with rates?
Well, I think it's partly the AI story, given the concentration of the Mag 7 in the equity market, and that's propelling things higher there. But I think there's also a realisation that policy might be about to become more predictable as well. So, obviously, the tariff story, we've stopped talking about that for now, but I think the market is relieved increasingly that it seems as though, I don't think it's over yet, but we're settling into a more stable equilibrium. So, with Trump having achieved a trade deal with the EU, OK, it looks like that's going to be 15% now. He's got a trade deal with Japan. He's got a trade deal. We've got another 90-day extension with China. It looks as though we're settling into a position where markets know what they're going to get. And even if the uncertainty does continue, that uncertainty is being priced in as a fact of life. I remember saying this 6 months ago, when this was beginning. If this keeps on going, it'll be like the first term. After a while, we'll just get used to tariff rates changing up and down. And so I think the market is basically adjusting to that. That's no longer such a negative catalyst as it was.
So we just focus on AI. Where does the risk lie in this market? Is it rate cuts? Is it the economy? Is it inflation? Or is it the DeepSeek story we're talking about this morning in terms of being able to change the narrative for NVIDIA or Meta? Or that's the bit that I don't get. Where should I be focusing my attention? Is it on what's happening in technology? Because you get a 5% drawdown in NVIDIA, that's going to have a really meaningful impact in terms of the index level, like a huge impact. Or is it inflation ticking up or down, what's happening with it seems, if you look at the numbers, it's tech that is driving things.
Yes, but I don't think it's exclusively tech. So I think in terms of what worries me, there's two things that you alluded to. One was inflation, because if the reason we don't get those rate cuts is higher inflation like 2022, then I think that's very bad news, rather than because growth is surprising on the upside. Well, it does, because those sectors are kind of sensitive to rates. And we saw that in 2022, that tech was actually one of the sectors that saw the biggest drawdown in the 2022 bear market.
So
some of those
inflation comes through, I sell tech.
I mean, it depends what else is happening on the other stories.
Sure.
But yes, other things equal.
Okay. Why do you think inflation? Why do you think we're not done with inflation?
Several reasons. So obviously, number one is the tariff story. That's not a one-off price shock. Those are sequential. So even on August 7th, we had the August 1st tariffs implemented. Canada went up to 35%, copper on 50%. Yeah. So that's a running story. We've still got reviews like on pharmaceuticals, on semiconductors. So there's still more to come potentially. We've also got the lagged impact of rate cuts. We know that rate cuts operate with a lag, 12 to 18 months peak. Actually, it's last year's rate cuts that are really going to be filtering through at this point. In other countries, actually, like Europe, of course, we still have got the fiscal stimulus story. Deficit's still pretty strong. We've just had the big, beautiful bill passed in the United States. So there's a lot of inflationary catalysts kind of building at the moment. And I don't think it's going to lead to a 2022-style spike. What I do think it's going to happen is you're going to see inflation linger above target in the threes in a position that really means it's not really credible for the Fed to start cutting rates. And a big difference between now and 2019, when Trump also pressured his first in the Fed to cut rates, is back in 2019, inflation PCE was running below the Fed's target.
Would you be surprised if the Fed doesn't cut rates in September?
No, I wouldn't be. Because, number one, inflation is running above target still. So from that side of their dual mandate, that says don't cut. And secondly, from the maximum employment side of their mandate, unemployment remains low. It's been in a 4 to 4.2% range for over a year now. And if jobs growth picks up, particularly if we get upward revisions, given the scale of these revisions, I think it's very easy to craft a narrative whereby they don't need to cut rates in September. Also, they might want to prove their independence against Trump.
That would be bold.
Yeah.
Great to see you.
It'll be a fair few dissents, though. I think we're well aware of that now, right?
Yeah, I think the Bank of England's the model. So if you look at what's happening at the Bank of England...
2 rounds of votes at a Fed meeting? No way.
So let's not extrapolate too far. But the level of dissent, the level of disagreement on these policy committees, I think is going to increase. You've seen that at the Bank of England. I don't think it would be a stretch to see that maybe happening more at the Fed as well. Henry, great to see you. Thanks for stopping by. Henry Allen, macro strategist, joining us from Deutsche Bank. Quick look at the Core 6. Let's just get through this quickly because I know Chloe's waiting with some really interesting stock stories. That's the picture this morning. Chloe, what do you got?
Good morning, guys. Let's start with ThyssenKrupp today. So the steel sector, ThyssenKrupp is way down. We're down 9% this morning on the back of a guidance cut. The CEO said it was dealing with a lot of uncertainty, enormous uncertainty in the market, and especially across end markets like automotive, engineering and construction. Moving on to the energy sector, we've got RWE this morning, and it's also down, not as much. We're down 2.7% this morning. The earnings were lower than expected. That's because of weak results from the trading business and from the power generation business. Moving on to a more positive story with Lundbeck this morning, which is up 8% due to a guidance raise. So it's drugs in the psychiatric and neurological kind of space did really well, especially in the US. We've got a guidance raise on the back of that, and therefore it's up. And then finally, let's talk about the insurance sector. We've got Aviva and Talanx this morning, both up. So Aviva increased its dividend, and then Talanx provided a forecast that was higher than expected. So we've got a bit of a positive movement in that insurance sector in Europe this morning.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Coming up on the program, we go right back to the shipping industry. German container shipping company Hapag-Lloyd narrowing its full-year earnings forecast. We'll get more on the trade picture. Those shares sinking fast. We'll get some commentary from the CEO. Stick with us. This is Bloomberg.
Less uncertainty than there was before. It's been a rocky year, as everybody knows, because of everything that's been happening, amongst others, on the tariff front. Having said that, I think we've had a very solid first half of the year, with especially pretty decent growth. And if we look ahead now, then despite some headwinds on the FX front, I think we felt comfortable to narrow down the range a bit.
Rolf Habben Jensen, CEO of Hapag-Lloyd, speaking to us earlier about narrowing that range. Just want to review those numbers here. The EBITDA, at least for the full year, went from a range of 2.5 billion to 4 billion. Now narrowing that range to 2.8 billion to 3.8 billion. So the upper end of that range has come down. To be fair, the bottom end of that range has also narrowed, but I think it's the upper end that is moving these shares by such a mass amount. Those shares dropping by about 10%, almost 11% this morning, alongside a series of warnings coming from the company when it comes to the geopolitical situation around the world. Bloomberg trade czar Brendan Murray is here to join us for more. Brendan, just in terms of the laundry list that has come out of some of these earnings, he's talking about the Red Sea. He's talking about trade uncertainty. He's talking about simply trade volumes and shipping rates. I think it's fair to say it's been a rocky year.
Yeah, rocky would be putting it lightly, I think. Look, these are Hapag-Lloyd and Maersk, and these companies are on the front lines of the trade disruptions, the trade wars that are emanating from Washington. Tariffs have been put in place, but they can come and go at President Trump's whim. And what these companies are reflecting, and I think what you heard from the CEO of Hapag-Lloyd today, was that there is a little bit more certainty, but there's still a lot that we don't know about where tariffs could go. These companies operate hundreds of vessels, and they cannot turn on, turn off capacity overnight. And so it takes a while for them to sort of shift and adjust to the demands of the marketplace. So I think that's what you're seeing is this company, like others, is having a difficult time navigating what is still an uncertain outlook.
The CEO also said that they need some sort of long-term certainty on the U.S.-China relationship. That was something that was echoed by the Maersk CEO when he spoke to us last week. Where do we stand on those negotiations? Are we likely to get the certainty that these shipping companies desire?
Well, the relationship between the U.S. and China right now is stable, I would say. That they're not escalating, but they're not throwing concessions toward each other to try to make any steps toward a free trade, a deal on trade that would alleviate some of the tariffs that we're seeing. So we're still seeing, and we heard Treasury Secretary Scott Bessent say recently that Chinese investment in the U.S. isn't really welcome. So it's cool, the relationship, but it's not going in either direction. It's just sort of stable, and companies like Hapag-Lloyd, need the world's largest trading relationship between the U.S. and China to be vigorous if they want to make money.
In terms of kind of the overall picture, are we seeing a rewiring of global trade? Everybody talks about the fact that tariffs would change the landscape dramatically. China would shift its emphasis dramatically. Are we seeing that? If so, how far through that process are we?
Well, it's really hard to see it move because it's going so slowly. Yeah. Overnight, we had a Chinese-owned company, GE Appliance, say that they are going to create 1,000 jobs in Kentucky. Now, that is exactly the kind of thing that President Trump wants, is a reshoring of industrial production. Of course, that's a Chinese-owned company, and so there's an irony there. But I think slowly we are seeing, and shipping lines, you can see it in the redistribution of some of the services that they offer between ports. It is starting to happen slowly, but whether it becomes the complete rewiring overhaul that President Trump wants it to be is still an open question, and is probably going to take many years to watch play out.
Talk to us a little bit then about the kind of FX impact as well when it comes to some of these trade negotiations. It's not just China we're talking about, but we've heard Hapag-Lloyd talk about it. We've heard several other companies talk about it as well. How much should we be paying attention to the FX piece as a symptom of this trade story? Yeah,
absolutely. We heard Bessent say recently, talk about how the BOJ is behind the curve and the yen is, and some people interpreted that as an attempt to weaken the dollar. So absolutely, the new paradigm that we're in, the dollar has declined, and that is definitely going to play a factor in all of these earnings that we're seeing.
All right, okay. Bloomberg's, go for it.
I'll do it.
Yes, thank you.
Nice to see you. Thank you very much indeed. Bloomberg's trader, Brendan Murray, thank you very much indeed. Let's turn our attention to what is happening in terms of the geopolitical story we're watching so carefully. Donald Trump has warned Russia will face consequences if Vladimir Putin does not agree to a ceasefire with Ukraine in the coming days.
Yes, they will. Yeah.
What will the consequences
there will be
consequences? Sanctions, tariffs?
There will be, I don't have to say, there will be very severe consequences.
That message comes after European leaders stressed to the US president that Ukraine needs robust security guarantees to ensure that any deal holds. At the moment, we think this is the narrative going into this meeting. The question is, will it end up be the narrative that comes out of this meeting? Vladimir Putin, obviously, no plan survives contact with the enemy, right? So let's kind of start from that premise.
Yeah.
You go into a meeting with Vladimir Putin, and Trump has a history of changing the narrative quite quickly, depending on who he's talking to. Does the message that European leaders have communicated to Trump, and Trump appears to agree with, survive contact with this meeting with Putin on Friday? And I think that's the key question that nobody has got their arms around at the moment.
It went very quickly from this is a listening exercise to if there's no ceasefire agreement or steps there to, or even a second meeting to follow, there will be severe consequences. And I want to go right back to what Scott Bessent said with our colleagues over in the States on surveillance yesterday. When he was asked about those Russian sanctions specifically, he said European leaders need to step up here and join on those sanctions, very specifically pointing out the fact that secondary sanctions, or tariffs have been used interchangeably for this, have been imposed on India. He hasn't said China yet, but that's assumed a part of those negotiations. And he says Europe isn't there yet. And he said, I think, direct quote, put up or shut up is what he was going to say to the European leaders. And I think it's crucial here that if European leaders don't have a seat at the table, not only in meeting 1, but meeting 2, if it surfaces, where does that leave Ukraine? And that's a big question mark for the bull case for Europe.
Yeah, well, maybe Bessent wants to see them put on those sanctions to almost deserve a seat at the table in these discussions. You could definitely argue that. But I want to talk about just how the market's been playing this week. We know that Brent crude has really been on a back foot since that weak payroll print. It's down around 9%. The other way to play this, other than weak oil prices on some sort of peace deal breakthrough, would be a positive move in the euro. And we just heard from our MLive strategist Mark Cudmore talking about how he wants to be bearish the dollar. There's been a surge of options activity to be long the euro. I wonder if that's going to be a favored way to play any excitement around a peace deal when it comes to markets.
But is there a kind of broader picture here, which is European markets aren't performing, so therefore do I want to move money into a currency that is seeing other markets not doing as well? That strikes me as being a reason for the euro not to be able to deliver on that kind of geopolitical bounce that maybe we get. You've also got the ECB's done. Is the Fed done? Kind of that's a factor you've got to fold in. That should be positive. So there's lots of different factors at play here. Is geopolitics really going to move the needle when it comes to the euro? Maybe.
Well, you could argue that if the main channel of the market reaction is via a lower oil price, with Europe being a energy importer, I mean, that could import deflation on the top of the deflation impulse from tariffs. So that could definitely argue that the ECB needs to do more, even though the market basically thinks that they're done at the moment.
The channel thus far of playing Ukraine, though, seems to have been through the defence narrative. And is there a negative effect that comes through in the defence story? Do you sell European defence companies on the back of a peace deal? And if you do, do you
buy the dip? Do you buy that dip?
Do you buy that dip, which would imply actually flows coming back in, or do you repatriate funds on the back of such a move and look elsewhere, thinking that deal, maybe that run is over?
But that's the fundamental narrative. There's also the sentiment narrative as well, which is that if you start to have this massive risk on European borders kind of removed, is that a massive win in itself? Do European markets just trade on good vibes if we do get some sort of massive move from this agreement or summit?
We're going to come back to some of the corporate stories in just a moment. I had to say, Adyen's getting absolutely smashed this morning. You miss in this reporting season, you are getting hit and hit hard. Look at what is happening with Hapag as well this morning. We're going to talk about Bilfinger next, out of Germany too. The industrial giant reaffirming its outlook. The CEO is coming up. That's next. This is Bloomberg.
This is the opening trade. About 30 minutes into today's session, starting to see a little bit of a shakeout, but I'm not sure what you're seeing behind me is representative of the actual fundamentals. Shocker. And I think this is important here because take a look at this move you're seeing higher in the DAX and the CAC 40, higher by 0.4%. Your underperformer is the FTSE 100, but not because things aren't going well in the UK or any sort of fundamentals there. Although we did have a change in the data, there is a lot of ex-dividends in this index. BP, Rio, Shell, that's likely weighing on that particular index, Guy.
Absolutely. A lot of XDs in the market today. Thursday for the FTSE 100 is XD day. You got 420 up, 419, 163 lower. But that's the story. Really light volume. I think we're going to get through what is happening here in terms of the story. Quick look at some of the 52-week highs. Aviva, Admiral, Prosus, all at 52-week highs today. Aviva out with numbers. We were speaking to the CEO a little bit earlier on. Very positive going forward. Still, she still sees, that's the hard thing to say on a Thursday morning this early, that there's a lot of work still to do. And the stock certainly reflecting that this morning. Much more upside. She still feels we've got this capital-light model that is not being reflected. Maybe it is a bit more today. So that's where where the 52-week highs are right now. There's a lot of stocks out there being punished for guidance. You see that at Hapag-Lloyd, you see it with Adyen this morning. Val, what else do we need to know?
Here's what else you need to know this morning, Guy. The U.S. Treasury Secretary Scott Bessent has told Bloomberg that the Bank of Japan is falling behind on curve in addressing inflation. Bessent's comments come as the Bank of Japan continues to have one of the lowest policy rates among major economies. The nation's key price gauge has remained at or above the bank's 2% target for more than 3 years. Han Hai posted a better-than-expected 27% rise in profit over the June quarter. The firm, which assembles NVIDIA servers and Apple iPhones, also projected the current quarter will deliver a 170% rise in revenue from servers made for AI tasks. And lastly, the UK economy fared better than expected in the second quarter, with gross domestic product rising 0.3%. The improvement brings some relief for Chancellor Rachel Reeves, but also raises the bar for further interest rate cuts from the Bank of England. Kriti?
Lots to digest when it comes to that data point. Of course, we have plenty of data on the other side of the Atlantic as well. PPI data is coming as well later today, Guy. This is an input into the PCE story. Do we see early signs that tariff read-through, if it's not hitting the consumers, is it hitting the businesses?
Yeah, that's what we're going to try and figure out. Also, this goes into PCE, so this is a key kind of input into the data that we're going to see on inflation that the Fed pays so much attention to. So you're going to want to watch what happens as well. I'm also going to be watching claims to see what happens with that picture there too. The market at the moment just kind of is discounting tariffs. Like, tariffs don't matter. Who cares about tariffs? They're not going to have an impact. They're not showing up yet, so let's not worry about them yet. Seems to be the overall story at the moment. The labour market, though, if you see a confirmation maybe of more labour market weakening today, does the market leap on that? Does it kind of confirm the narrative, confirm the trend? The claims data has been ticking up. The ongoing, that's the picture. We're seeing a weakening labour market at the moment. The narrative from the Fed at the moment isn't that worrying, though.
Yeah, exactly. We've yet to hear from Fed Chair Jerome Powell after he characterized the labor market as solid some 13 times in his press conference before those payroll revisions. We do have to look forward to Jackson Hole, though, next Thursday and Friday, where he is going to make a speech. And that theme of Jackson Hole is the labor market. So, yes, we've been more nervous about the labor market, more sensitive to perhaps the weekly jobless claims figures coming out today because of that.
Is he really going to say anything juicy about the jobs market?
Let's hope, Kriti.
Let's hope so. Yeah.
It's summer. I'm sure he's just going to...
Jackson Hole looks really nice, though.
Enjoy the nature, is what I was going to say.
That's the place to do it. Relax, take it easy. Shake everything up.
Worry about the labor market at the same time.
Noted. Let's go back to the earnings story because, of course, even though I feel like everyone else is taking it easy, the earnings, at least in Europe, are coming in hot and heavy. Bilfinger is out with its latest quarterly results. The company reaffirming its outlook for 2025. Those shares higher by 0.5%. The industrial giant saying orders in the second quarter were good, with free cash flow more than doubling. Thomas Schulz, the CEO of Bilfinger, joins us this morning. Thomas, a pleasure to have you on the program. Thank you so much for your time. It's interesting that your free cash flow has doubled. Walk us through your earnings picture and how you can kind of afford that kind of liquidity.
We said roughly 2-3 years ago that we work intensively to improve the processes within the company. And that pays off, and more to come, to be honest. We actually said that we will have a cash conversion ratio over 80%. And you know that at the end of the year, on the 2nd of December, we have a new Capital Markets Day, and we will come with new midterm targets up to 2030. And you can expect some, let's say, better figures for that, what we have as an outlook in that area of cash flow too.
Thomas, I want to take a little bit of a step back. One of the big themes we've been talking about on the show today and certainly throughout the week is the believability when it comes to investment in Europe, whether or not that's funded or incentivized by, say, the German government, among many others. As a German company, how are you thinking about that confidence with which to invest and the confidence specifically when it comes to investing in industrials?
It is absolutely necessary to make it fairly clear. Especially Germany enjoyed more than 10-15 years, too weak investments, too much bureaucracy, and a lot of things which actually blocked the industry and the economy quite a lot. We hope that what was said in the last 3 months from the new German government will unlock a lot of potential. The industry is prepared for. You know, we as Bilfinger, we are more or less in all industries, only automotive not. We are like a barometer. And I can tell you that the expectation is very positive. if execution of the political government, of the top government, then leads to reforms in different areas. For Europe, it's positive. We see in defense, we see in infrastructure, we actually see, despite all the tariffs talks, quite a positive movement all over Europe regarding investments in Europe.
Thomas, what is your degree of confidence that the German government is going to deliver on your, what sounds like, lofty expectations?
You know, I'm standing here with a Q2 result with the all-time high order intake, what we created. In a time where in Germany, and typical for German culture, they complain about everything, and I will not exclude myself on that. I think the German government had, especially the Minister for Economy, had very relevant positive developments for the German society as well as the economy as a proposal. Now it's about that the German Chancellor is backing her, that the German Chancellor and the German government and the smaller coalition partner are recognizing we are at the crossroad. We can go left and doing nothing, or we go to the right side and saying these are the reforms what we will do. The money is there because they announced that. The industry is prepared, the society is prepared. I think if they play the book in the right way, we will have some profitable growth for the future in Germany, and with that for Europe.
Okay, so expectations are high. You talk about your customers and you talk about what is happening in German industry. Is it consistent across the board? Are all of your customers saying the same thing? Are there pockets where we are seeing more exuberance and pockets where we're seeing maybe a little bit more caution? I keep looking at the PMI data, for instance, out of Germany. The chemical sector in particular is one that stands out to me as being maybe a little bit more cautious. How consistent is the message coming from your customers?
The thing is, at the moment, it's hope, it's expectation. You don't see it in the figures, the positive development, at all. It's not there. Actually, the real world in the industry in Germany, especially in the process industry, chemical, petrochem, is a very challenging situation. But, as I said before, there are a lot of good things on the table to decide for the government, and with that for the industry and the economy to go in the right way. We see as Bilfinger that we can help, and we do that quite a lot throughout Germany, our clients in the challenging times with high infrastructure costs, with high energy costs, and so on. But if the government is only taking a few of the good ideas into action and execution, the side will change to the positive.
Thomas, you're talking there about how this government investment from Germany is absolutely necessary. What steps, though, are you taking in order to prepare for what you're expecting as a pickup in business, a pickup in this government investment? What steps are you taking now to prepare for that to come?
We are the expert for efficiency improvement for our clients. We are the expert in giving our clients a lot, hundreds, thousands of well-educated people, helping them in maintenance, turnaround, engineering, wherever we work. So when we hear that there's a big need for educated people, we have them. If we hear that there are challenges to reduce or to increase production rates, it's all about that what we do in Bilfinger. That's the good model what we have, the flexible model. If it goes up, we can grow. If it goes down, we can grow. And we show that. So out of that, if the government is, as I said before, looking into to increase productivity, raising the work time per week, talking about how much social fare and social part in the cost the companies and the employees have to carry, and trying to reduce that, this will be positive. And it will be positive not only for German investments within Germany, it will be positive for foreign investments in Germany, what we lacked under the two former governments quite a lot.
Thomas, your shares are near all-time highs, but many of the industries you supply, such as the chemicals industry, the pharmaceuticals industry, are not in their best shape off the back of tariffs and higher energy costs. How would you explain the difference between how your shares have performed versus the wider industrial industry?
Yeah, I would like to explain that a little bit about the strategy, what we have. We help customers in expansion times as well as in challenging times to improve efficiency. That is what we are really best at. That means if a client, let's say in the chemical industry in Germany, is under pressure, we can offer a lot to take over people, to take over business, to take over maintenance, and to bring in each year more performance, more bang for the buck for the client. And on that we earn. That's our business model. Of course, in a business expansion situation, as we see in the Middle East, in parts of Europe or North America, we help customers to realize that as efficient, as quick as possible. So this kind of business model makes us more resilient against the swings in the industry. On the other side, we are actually in all industries beside automotive. We are in energy, we are in pharma, biopharma, we are in mining, we are in metal, we are in cement, we are in oil and gas, we are in petrochem, we are in chemicals, everywhere where you have liquids and gases. And we always can add a notch better in efficiency. And with that, we have a lot to work, definitely. So from our point of view, it sounds a little bit odd, but we have a good time, and you see it in the all-time high order intake, what we had in the quarter.
Thomas, great stuff. Thanks for spending some time with us this morning. Really appreciate the update. Thomas Schulz, the CEO of Bilfinger, on the back of its numbers. Mixed market this morning. Stock holding its own. One stock that is not holding its own is Adyen this morning. It is under significant pressure, as you can see. Basically, any kind of a miss, any kind of a hint at a miss, anything that speaks maybe to guidance being tightened. You can see this with Hapag as well. You are being hit and hit hard this morning. And Adyen certainly getting the rough end of the stick this morning. But you've seen it throughout the earnings season. I was talking to Mike Masika about this earlier. Any hint at a miss in Europe, and boom, those are the kinds of numbers that you see on the screen. It
speaks to how frayed nerves are on both sides of the Atlantic when it comes to the uncertainty. Coming up on the program, we're going to continue the earnings conversation. We speak to the Swiss Re CEO as the reinsurer posts a beat on headline net income. That conversation next. This is Bloomberg.
Welcome back to the opening trade. We're 47 minutes into today's session here in Europe, and it's looking fairly positive for the broad European benchmark. Euro Stoxx 600 up 0.25%, adding to this week's gains. We're also seeing green across the screen for the DAX and the CAC. The one outlier is the FTSE 100, down 0.1%, but that has a lot to do with some of the stocks being ex-div today. Guy.
Absolutely. Let's talk about one stock that is higher this morning. Swiss Re shares up after the reinsurance giant posted a net income beat earlier this morning, despite more challenging property and casualty pricing that we are seeing at the moment. The company's CEO is Andreas Berger. He joins us now. Andreas, the market is focusing on the headline beats. The stock is trading higher. Is it as good as it looks?
Yes, thanks for having me, first of all. And I can say it's a good day for our customers, the insurance companies, the corporates, and the public sector. Why? Because they need a strong reinsurance industry as a shock absorber and a strong Swiss Re. 2.6 billion net income, 23% ROE. All businesses have contributed to this result. A good asset management result with a return on investment of 4.1% and a strong balance sheet with a solvency ratio of 264, way above our range that is between 200 and 250%. So all in all, I think good news. You refer to the pricing ranges and the cycle. Yes, we saw some reduction in rates, but we're still operating in a very, very risk adequate and very healthy margin space. So no bad news here. So I think we're quite happy with the first half of the year. Now we're focusing obviously on the second half of the year.
So how would you describe what kind of a cycle are we in? Is this a hard cycle and the pricing environment solid and as a result of which you can move on? Or is actually the cycle starting to soften a little bit and the pricing environment doesn't look maybe quite so good going forward?
Yeah. So first of all, there's not one cycle. We operate in various lines of businesses, product areas. So they have various different cycles. So maybe people certainly focus on certain lines of businesses that show some decline. But we do have other lines of business that do not correlate with these price cycles. So they obviously go upwards. So that's the composition of our portfolio that we look at. And we make sure that the overall composition is strong, resilient, in order to produce such kind of results. So we're not looking necessarily also at top-line growth only. We look at bottom-line growth. Obviously, we grow the book, we grow in attractive areas, and we see in particular rate increases in areas that are prone, loss prone, yeah, like nat cat areas, certain nat cat areas. There definitely rates might also go up.
Well, Andreas, it's Kriti in London. Thank you for your time this morning. Let's talk about the areas of your portfolio or of your bottom line where you may see some of that softness when it comes to the cycle. How are you preparing for that?
We have an approach internally. We have a 5-year forward-looking view where we collect all the information and look at pricing trends that we see. And that's exactly the information that we need, and look at the shape of our portfolio. Is the portfolio shape good enough to produce actually the financial outcomes that we expect? And that's the kind of cycle management that we do continuously. And that's an exercise internally. We call it Smart Circle because all the information actually comes in, the losses, the trends that we see, and that obviously goes into our models and then is translated into pricing into the market. And what we observe is then really how the actual losses coming through and how do they compare to our expectations in our models. And that will be fine-tuned over and over again. And that kind of information we share with our customers because they themselves have to actually manage those exposures in their books and their balance sheets.
Andreas, you're trying to cut costs, right? You've taken on consultants. You're trying to look at how you cut costs in the business right now. If that's the case, shouldn't I conclude from that that you're slightly concerned about the pricing environment rolling over? Insurers normally cut costs when pricing starts to soften. Isn't that the right read?
Yeah, we're not cutting costs for the reason because we want to cut costs. What we try to do is to streamline our organization, to become quicker, to be more closer to customers, and also to have a better productivity in our core businesses. That's the main focus. The outcome obviously will be a cost reduction. We said, yes, we want to reduce our expenses by more than 300 million run rate, based in end of 2027. And we're well on track. We have streamlined portfolios where we're underperforming, where we were not the best owners. So all these activities added up and contributed to the expense reduction. But what we will have to do going forward, obviously, we will have to measure productivities in our business. And there's definitely some room for improvement, and we'll continuously do that. It's a continuous improvement aspect that we introduce in our business.
Andreas, you joined us from Zurich this morning, so I'd like to take a quick step back and ask you kind of a twofold question. One, given the tariff uncertainty, given the business uncertainty right now emanating out of Washington, I'd like to ask you what the mood is as a Swiss company executive this morning, but then also how are you navigating some of the FX pressures just given how strong the Swiss franc is?
Yeah, I can say that Swiss Re is a global company. Yes, we're based in Switzerland. We have the name Swiss in our brand, but we are global in nature. We have a strong business in the US. The US is our single largest market. We have a legal entity, 2 legal entities in the US. We're licensed in Missouri and New York. We've got 2,400 people working for Swiss Re in the US and working with the customers in the US market. We have a global business model, but actually we are close to our customers in those markets, and we've got 15 offices over there. So the impact of tariffs, we don't see them directly impacting Swiss Re or our industry. What we do is we have a task force and we try to find out, are there indirect impacts? For instance, are the costs for losses going up because repairs are being more expensive in future, etc.? These things we monitor very closely. But what we do at the moment is apply strategic patience, I always say. There's no reason to panic. There's no reason to shoot from the hip. Let's be cautious, obviously, and let's factor in all the information that we can gather. On the FX, yes, we can see that the Swiss franc has appreciated significantly. But in our business, again, we have seen a positive, actually, in the first half of the year of $150 million on the FX side. Half of our earnings are actually in non-US denominated foreign currencies. And what we do is actually, at the group level, we try to mitigate the fluctuations of foreign exchange.
Yeah.
So at the moment, yes, we're managing the situation, we're observing it.
All right, Andreas Berger, CEO of Swiss Re, joining us this morning. We thank you so much for your time. We look forward to seeing how the uncertainty sustains or is navigated in the European markets. In the meantime, plenty to watch in the day ahead. We have a Nordbank rate decision in just about 5 minutes' time, plus plenty of earnings over in the States, Deere and Applied Materials. But I think the focus around this table is very much on that U.S. jobs data, jobless claims data, and then PPI numbers, of course.
Yeah, it could be a big day. I mean, maybe we get a different read from the U.S. PPI report versus the CPI report that the market reacted as if it was a cool print. And then with jobless claims, you've seen continuing claims creep higher. And I think the market is really reviewing what this means, given the backdrop of those weak payroll revisions.
See, it's interesting. CPI, in theory, should be the fast twitch kind of inflation reaction. You get the consumer, the stuff as a consumer you're buying doesn't get caught up in long supply chains, maybe, that the industrials do. We were hearing from Henrik Andersen a little bit earlier, talking from Vestas' point of view. Pricing takes a long time to work its way through the system. In theory, it shouldn't show up in PPI as early. There's another argument that says that it should show up there because ultimately it gets passed on to the consumer. Yeah. So I don't know. I'm muddled as to where we are in this journey on tariffs.
But isn't this potentially the other risk here, that if it's not a demand crunch that everyone is kind of waiting for when it comes to the tariff imprint, if most of the pressure is being absorbed by these companies, where is the margin compression? Where is the liquidity buffers that everyone's creating? Isn't that the bit that should be showing up in these corporate earnings? We've had a couple, and we're not seeing that kind of panic yet show up in the corporate earnings, but maybe that's next quarter story.
No, it's funny. It's definitely something to remark on, that we're seeing this tariff revenue go into the Treasury's back pocket, but margins aren't being compressed. So what's happening here?
Unless this is just like a COVID stimulus hangover because so many corporates have so much cash anyway, maybe that's it.
Yeah, inventory build-up is another fact. It's a confusing picture. We all thought it was going to happen fast. We all thought that there was going to be an instant kind of feed-through and a reaction. We're not getting that. It's muddled and it's taking time. Anyway, that's the show. Hope you enjoyed it. The Pulse is up next. This is Bloomberg.